Hello, 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 hello. Welcome to our next chapter, that is security valuation. I just got a new haircut and we'll start with this chapter. Okay, so now security valuation come for about 12 to 14 marks in every attempt on an average. This chapter is broken into two parts. First is your valuation of equity shares and second is your valuation of debt. Okay, so now valuation of equity shares is in three ways, that is dividend based model, earning based model, and then third we have is cash flow based model, and then we have some ways to value our firm. Okay, so let's start with our first one, that is dividend based model. This everybody knows, the one that we keep doing from Inter as well, that is your Gordon's dividend method. So this is very similar. So what does it say? It assumes that dividend is paid annually at the end of each year and sale occurs at the year end at X dividend price. Whenever we say X dividend price, that means that the price excludes dividend. That means dividend has already been paid out and then the share is sold. So basically you are going to value this share based on whatever outcome, whatever out cash inflows you receive from it. So, the example, a firm pays a dividend of rupees 1 per share. Okay. If dividend is expected to grow at the rate of 20% per annum, that means first year I'll get 1 rupee, then I'll get 1.2, then I'll get 1.2 square. Okay. For 5 years and 10% per year thereafter. So, till 5 years we will get 20% growth, and after 5 years we will get 10% growth. If the required rate of return is 12%, whenever they say required rate of return is 12%, that means this is your discounting factor. What is the price of the share? Very simple. So for 5 years we will keep discounting it, so we will do 1 into 1.2, because 1 is currently our growth will be at 20%, so we multiply it by 1.2 raised to the power 1 and divided it by 1.12 raised to the power 1. Then for second year, we again do the same thing, 1.20 whole square upon 1.12 whole square, because now we are also going to discount it by 2 years. Similarly, we do this for 5 years. So basically, this is your first year, this is second year, this is third year, this is fourth year, and this is fifth year. Now, what happens after the fifth year? It says that it is going to pay 10% forever. So how do you find? How do you find the perpetual value? So in such a case, you multiply with whatever value you have. So at the end of fifth year, what is the dividend value? End of fifth year is 1 into 1.20 raised to the power 5. Correct? Now what will it become? It will become multiplied by 1.10. So therefore, this is value at the end of fifth year. And this, what we are multiplying is, this is value that we are going to get thereafter. So we multiplied by 1.10 divided by, you divided by KE minus G. This is your formula. Remember Gordon's formula? So this is your KE and this is your G. So you will get the entire value. You will get the value, that is the entire value at the end of year 5. You will get that value. So now this year 5 also has to be brought into present value. So therefore you will again multiply it by 1.12 divided by 5. So you will multiply it by 1 divided by 1.12 raised to the power 5. That is, you are getting it to the present value. So this is value of share at the end of fifth year. That is this part, and the second is discount rate for the present value. So you get the value of 83.83. 83.83 is your value of share as on today. This is your price zero as on today. Okay, so this is your dividend based model. Next is your earning based model. So now earning based model, this is the same one that we just discussed, that is P into EPS into 1 minus B upon K minus B. Sir, this seems a little different. Is there a difference? Answer is no. If they say EPS, if they say EPS 1 into 1 minus B, what do we mean by B? B is your retention ratio. B is your retention ratio. So if we do 1 minus B, if we do 1 minus B, isn't that your dividend ratio? That means how much dividend you have paid. So if this 1 minus B is a dividend ratio and you multiply it by EPS, if you multiply it by EPS into this ratio, is this not basically dividend per share? Tell me. So basically this is dividend per share divided by KE minus BR. When we say BR, B is your retention ratio and R is your return on equity. B into R is nothing but growth. So therefore, this is the same formula. This is the same formula of DPS upon KE minus G. Okay, so this is your Gordon's model. What does Walter's model say? What Walter's model does? Dividend per share plus, it says dividend per share that has already been paid plus EPS minus DPS. When we say EPS minus DPS, what do we mean? That is the portion that is left. Correct. So this is the portion that is left, that is EPS. The DPS, that is what we've already given, plus EPS minus DPS, that is the portion that is still left in the company. You multiply it by R by KE. You multiply it by R by KE and then you divide the whole thing by KE, will give you the value as per Walter's approach. So basically, what does Walter do? Walter do dividend. So there is no growth in dividend. So dividend is as it is. You take, but the portion that is still in the company will be subjected to some growth, so that will be multiplied by R by K. That is your return on equity divided by your cost of equity, and then you divide the whole thing by K. Great. And now last is your multiplier approach. Multiplier approach is nothing but it's just say that price is equal to EPS into PE ratio. That is your earning per share into the P ratio. So usually there is an industry P ratio, that is the price to earning ratio. So therefore, honestly, if you see when we say PE ratio, we just do price upon earning per share. This is the formula. So in this case, if you see, we have done nothing but price into P ratio into EP. This has gone here. Okay. So this is just the same. This is actually P ratio just structured in this way, so that price is equal to EPS into P ratio. Got it? Perfect. Next is your cash flow based model. Cash flow based model talks about two parts. This is the interesting part and I want you to pay attention here. First is your free cash flow to firm, that is the actual cash that the firm is getting. And second is free cash flow to equity, that is the actual cash left for equity shareholders. That means what will be the difference? Tell me, what will be the difference between firm and equity? Equity you will arrive only after paying. Equity you will arrive only after paying all interest and any preferred dividend. Only then will you arrive at the equity. So basically, free cash flow to firm minus your interest payments minus your preferred dividend will become your free cash flow to equity. So free cash flow to firm talks about cash available to all capital holders, all capital providers. Discounting factor will be KO, that is your cost of capital. Okay, that is usually your weighted average cost of capital. However, for free cash flow to equity, because of course you will have to divide it by something. Over there we were dividing by K minus G. Over here also you will have to divide it by some denominator. Na? So therefore, if it is free cash flow to firm, VAT will be used, and if it is free cash flow to equity, then your cost of equity, that is KE, will be in the denominator. Perfect. Great. So your formula first is your FCFF is equal to profit after tax plus interest 1 minus tax plus depreciation plus minus capex plus minus change in working capital. Okay, let's see what exactly this is. If you see your profit after tax has already reduced interest and has already reduced tax. Correct. Your PAT you will get only after subtracting all of these things. But what you have to understand that what we have to do is cash available to all capital providers. So this interest should be added back. Correct. So interest should be added back and not the entire interest can be added back. Therefore, we will do interest into 1 minus tax is added back. Therefore, this is your first adjustment to PAT. Second is your depreciation. So depreciation by depreciation is a non-cash expense. So basically, whatever they are adding here is basically your non-cash expenses should be added. So depreciation is a non-cash expense. Tell me, does it affect your cash flow? The answer is no. So therefore, depreciation will have to be added back completely. So first is interest multiplied by 1 minus tax, and second is your depreciation. And then whatever changes is changes in capex. That is whatever increase capital expenditure you have to do each year, that will be added or subtracted, and next would be your change in working capital. Okay, this is your FCFF formula. Next FCFF formula is EBIT 1 minus tax. When we say we are starting with EBIT 1 minus tax, EBIT is earning before interest and tax. That means, have we given effect of interest? Answer is no. Have we given effect of tax? Answer is no. So, but we have to give interest. We have to give effect of tax. Government is not a finance provider. Your finance providers are equity, debt, and your preferred share capital. So therefore, EBIT into 1 minus tax. So at least you first get rid of the tax portion, that is EBIT 1 minus tax. Now will we subtract interest? Answer is no, because interest is still in the business. So therefore, because we are doing free cash flow to firm, we do not have to subtract interest. So your whatever earning, whatever cash flow, that is including interest. So you only add depreciation and your formula gets over. You only have to give effect of capex and your working capital. If your capex is increasing, your capex will be subtracted. If your capex is reducing, your capex will be added. Next is your FCFF formula. If it is starting from EBITDA, that means earning before interest, tax, depreciation, and amortization. Over here, you see your depreciation. Your depreciation has not been subtracted, but you have to get benefit of depreciation tax part, correct? So therefore, what do we do? You do again, you multiplied by 1 minus tax. So now the tax portion has gone. EBITDA 1 minus tax has been gone. Since you have not subtracted depreciation, tell me, will you not be paying a higher tax? Correct. So therefore, more tax portion will be gone. But you have to reverse it. So therefore, you add depreciation into tax rate. You add depreciation into tax rate. That is whatever benefit, whatever benefit you are going to get on the depreciation part, that will be added back. Whatever tax benefit you should get on depreciation will be added back. So we've added that back. Then again, similarly, you add capex and working capital. Is this all clear? Perfect. Last three formulas are much simpler. That is FCFF, that is cash flow from operations plus interest into 1 minus tax plus capex. Because cash flow from operations does not include any of your other income. It is only from operations. So now you will be adding the interest portion and the capex part. Next is your FCFF is equal to FCFE. That is how to move from FCFF to FCFE. This is a formula. The second last formula is your relation between FCFF and FCFE. FCFE plus interest 1 minus tax plus any principal that has been prepaid minus any net new debt issued plus any preferred dividend that has been paid out. Okay. And last is your FCFE is equal to net income minus 1 minus debt percentage into capex minus depreciation plus minus change in working capital. Last formula is a little confusing, so I have put an example for it. Okay. I hope you do not have to learn these formulas and you are able to understand them. Perfect. So we follow the same procedure in our entire AFM in 50-page note. That is, whatever is in the colored part will be part of your question. Whatever is in black and white will be part of your answer. Okay. So now they say profit after tax of company is equal to 290 crore. Is this my PAT? Tell me. My PAT is equal to 290 crores. Equity capital of the company is 1300 crores. Perfect. Equity capital is 1300 crores. Par value of share is equal to 40. So tell me, if I have total equity that is 1300 and I have par value of share that is 14, can I divide both of these and get how many number of equity shares I have? Right? Okay. Next is debt upon debt plus equity is equal to 0.27. That means my out of my total capital, 27% is debt. Long run growth rate of company is equal to 8%. Perfect. So they've given us G. Beta is equal to 0.1. Risk-free rate is equal to 8.7%. Market return is equal to 10.3%. The moment you should see all of these all of these components, you should understand that I will now be able to calculate my cost of equity using CAPM. What is that? That is RF plus beta into RM minus RF. So they've given you all of that information. Then they've given you capex per share, they've given you depreciation per share, and they've given you change in working capital also per share. That is your 3.45. Okay, so see, in this question, all of the information that they've given you is per share. That is nothing different. All of the everything remains same. Just we have to divide it by number of equity shares. So your number of shares, as we had discussed, we calculated that is 32.5 crores. Now your EPS is your PAT, correct? Your EPS is your PAT divided by number of equity shares, that you get 8.923. This is nothing but your net income, correct? So over here, when we are saying net income, this is nothing but your PAT. So your 8.923. Then next is your FCFE formula. FCFE formula is net income 1 minus P into capex minus depreciation into your working capital. So in this case, this percentage has been given you as 27%, correct? So your 8.923 is your net income. You minus 1 minus 0.27. Correct. So basically, how much is your equity portion? Only we are keeping. We are only keeping for equity portion. And then they've given you capex as 47, depreciation as 39, and this as 3.45. So you've only given these effects, that is 47, 39, and 3.45. So your free cash flow to equity is your 0.5645. Now tell me, is this per share or not? Answer is yes, this is per share, because all of this was per share. Okay. So this is your per share. Then comes your cost of equity, that is using your CAPM method. This is your CAPM method, that is RF into beta into RM minus RF. All of that has been given. That comes to your 8.86%. And therefore now you are able to calculate price of the share, that is FCFE into 1 plus G. FCFE comes your 0.5645. We multiplied by the growth rate that was given in the question, that is your 8%, divided by KE minus G. KE is 8.86%. So you do 0.0886 minus 0.008 and you get a price of 70.89. Here, let's move on to the next part. Perfecto. Okay. Next is your enterprise value. Enterprise value is your total firm's value, that is your market capitalization. Your market capitalization plus your long-term debt plus minority interest minus cash and cash equivalents. Why have they added? Okay, we understand market capitalization is your equity part, correct? This is basically the equity that trades. Long-term debt, okay, we know value of firm is equal to debt plus equity. This we know. Sir, why is minority interest being added? What is this part? Whenever a company is being consolidated, you have some minority interest in your subsidiary also. In your subsidiary, there are some other minority holders also. So therefore, this also has to be added. So this minority interest is minority interest of others in your subsidiary. So therefore, this has to be added. And you subtract cash and cash equivalents. You subtract cash and cash equivalents, because this is basically your cash. So say for example, if you purchased a business and you got some cash also with it, so this is basically you just paid more for the business. This also includes the cash part. So therefore, this will be subtracted. Clear? Okay. Next is your operating enterprise value. Operating enterprise value is your total enterprise value. Total enterprise value minus market value of non-operating assets. What do we mean by operating assets? Operating assets are those assets which are crucial for your business, which are used to generate revenue in your business. Tell me, if I am a company that sells toys, whatever money I'm getting, I put it in investments. Tell me, is that an operating asset? Answer is no. I am just putting my unutilized funds to better use. So therefore, any non-operating assets will be subtracted. That is something like investment in shares. Next is your core enterprise value. That is your operating enterprise value. Operating enterprise value minus your non-core assets. Your non-core assets could be an office building, say for example. That is not your core asset. Your core asset would be your machinery, your plant, your land, your patents. All of that would be your core assets. All of this would come under non-core assets. Clear? So it would still be operating asset, but those are not core assets. So therefore, this is the way you break down enterprise value. That is enterprise value, operating enterprise value, and then you have your core enterprise value. Next is your valuation of rights. Valuation of rights. What is a right? Basically, I hold some shares. Now my company needs some more money. So instead of going to the public, they go to their existing shareholders. See boss, the current market price is about 30 rupees, you only give me 20 rupees. Instead of the company going to random strangers, random new people, the company goes to its existing investors and says that you have a right to buy the shares at a discount from the market price. That is a right. Sometimes I have this right, but I don't want to invest more. What do? I can sell this right to somebody else. So does that person need to hold the shares? Answer is no. I can sell it to anybody. So therefore, I have differentiated this right from me. So how much can I sell this right for? Answer is say market price is 30 rupees. I am getting an option to buy it 20 rupees. So therefore the difference is about 10 rupees. So value of this right is 10 rupees. Value of the right is difference between the market price and the exercise price. Got it? So now you have to calculate what would be the value of the share after rights. Got the question? After the rights, what will be the value of the share? So now tell me the value of share will increase or decrease? It will decrease, correct? Because till now it was 30 rupees per share, but now the new shares are issued at only 20 rupees. So therefore my X right price, that is after right price, will be less. How do we see? Okay. So we see that first is your what was the price before the right issue. Price before the right issue was say 30 rupees, and how many number of shares you first multiply both of that. That is your value of share into number of rights. Got it? Then then you add the subscription amount that is raised. That is the new money that is raised. Okay. So you had earlier how much you had. Now you are adding how much new you are getting, and you divide this by n plus n1. That is now your total number of shares. That is what you held earlier plus now what you have issued. Basic, simple. Total how much you had earlier plus how much you raised now. This is the total you have divided by number of shares you had earlier plus number of new shares that you have issued. So this is the price of share after the right issue. You have to tell me what is the theoretical value of right per share. So theoretical value of right per share is X right price minus your subscription price. That is the price after the right minus your subscription price divided by existing number of shares. That is your theoretical value of right per share. Because this is the price that will happen and this is the price that I have to pay. So my gain is only the difference between these two. And this gain is spread among how many number of shares. So therefore we are dividing it. Perfect. Okay. Preference shares are valued by bringing future dividends and redeemable value of the preference share at your present value by discounting by required rate of return. Normal simple dividends and your required rate of return is used to calculate this present value. Okay, I hope the equity part was clear. Now we will go to the valuation of debentures and bonds. Okay, now valuation of debentures and bonds, we will first understand some concepts before we start the question. Okay. So first is your yield to maturity. What do we mean by yield to maturity? By yield to maturity, we mean at what percentage, at what rate does my present value become the market value? Didn't get it. Okay. Say for example, the debenture today is trading at 500 rupees. But my cash flows that total cash flows are 700 rupees from it. So at what rate do I divide 700 so that I get 500 rupees? That is your yield to maturity. That is at what discount rate? It is at what discount rate the present value of future cash flow from bonds equal to the market price of the bond. Got it? Next, if the YTM is equal to your coupon rate, for example, your debenture pays 10% coupon rate and your yield to maturity is also 10%, we would say your debenture is trading at par. That means your redemption value, the debenture's redemption value is equal to the current trading value, that is at par. Next is your when YTM is greater than your coupon rate. When your YTM is greater than your coupon rate, that means, say for example, your coupon rate is 10%, but your YTM gives you 12%. That means the debenture is trading at a discount. And third is when YTM is less than coupon rate, your debenture is trading at a premium. Clear? Okay. Next, longer the maturity of a bond, greater the bond price changes with a given change in required rate of return. So, what do we mean by this? When we say longer the maturity of a bond, that means the duration of the bond, greater the bond price change with the given change in required rate of return. Everybody knows now that your price of the bond changes as the rate changes. So, say for example, if my debenture is paying 10%. Okay, if my debenture is paying 10%, but the market rates are now 12%. So now my debenture will start trading at a discount. So therefore, any changes in market rate will affect the price of my debenture. So they are saying if my debenture is of 1 year, this 2% change will bring a very small percentage change in the price of my debenture. Versus if my debenture was for 10 years, then this 2% change will become a very huge change. Why I tell you? Because when we say price of a debenture, when we say price of a debenture is equal to its interest payment for first year upon 1 plus, right now I'll call it discounting factor, plus its interest rate for second year upon 1 plus discounting rate whole square, plus interest for third year, and so on, it keeps going. Correct? So the longer the duration, will this 1 plus discount rate, 1 plus discount rate whole square, etc., be more times? And therefore, this discount rate changes with the market. So therefore, any change on a bond with a greater duration will have a greater effect on the price of the bond. This is what we mean by this statement. Correct? If this was only for 1 year, we would only have this effect. But since it is so many years, this discounting factor will come so many times in the denominator. Okay, perfect. Next is your yield and price have inverse relation. What do we mean by yield and price have inverse relation? Your discounting factor is basically your yield and your price is your numerator. So basically, as your denominator keeps on increasing, your price will keep on falling, correct? Over here, as the discount rate keeps on increasing, will this not fall, tell me? So therefore, both of these have an inverse relation. As your discount rate increases, your price reduces, and as your discount rate falls, your price also increases. Got it? So both of them have an inverse relation. Next, duration is the weighted average time to get back promised principal and your YTM. So if your bond is of 10 years, it is not that you get your entire money back only after 10 years, because during the year you keep getting some interest, and at the end you also get a lump sum. So your duration is always less. Your duration is always less than the actual maturity period. Except, except in case of a bond that does not pay any interest, that is your ZCB, that is your zero coupon bonds. Got it? Because every year you get 10 rupees, every year you keep getting 10 rupees, you invest this 10 rupees also, no? So therefore you generate money out of this 10 rupees also. So therefore your duration is your weighted average time to get back promised principal at your YTM. As the coupon rate increases, duration reduces. Of course, as you get more interest earlier, your duration will keep on reducing, because that interest also keeps on multiplying. As your YTM increases, your duration reduces. Perfect. So we have three formulas. First is your Macaulay duration. Second is your modified duration. And third is your volatility. What do we mean by Macaulay duration? It is weighted average present value divided by present value. We will solve a question, don't worry. Okay. So this usually we use to calculate duration. Whenever the question says calculate duration, you are going to use this formula. Next is your modified duration. What does modified duration say? It is the same. It says Macaulay duration divided by 1 plus YTM upon M. Okay, this is just a simple change. And last is your volatility, that is your Macaulay duration divided by your 1 plus yield, that is your volatility. Okay, perfect. Yes. So we have a question. Question says that your face value is 1000 rupees, your coupon rate is 16%. Okay, great. Bond it pays 16% coupon rate. Maturity is 6 years. Okay, redemption value is also 1000. So your face value is also 1000, redemption value is also 1000. Your yield to maturity is 17%. Coupon rate is 16% and your YTM is 17%. Tell me, just looking at these two figures, tell me, will the bond price that we calculate, will that come at a discount? Will that come less than 1000 or more than 1000? Answer is more than 1000, because we will be dividing 16 by 1.17. We will be dividing 16 by 1.17. So therefore, your price will come less than 1000. Find the current market price. We know your current market price will be less than 1000. Also calculate duration and volatility. Okay. So your current market price will be 160 rupees. Your current market price will be 160 rupees for 6 years divided by discounted by 17% plus 1000 that you will get at the end of 6 years. So 17% 6 years. So you will get a price of 964.24. This is using the formula. This is the market price that you are calculating. That is, every year you will keep getting coupon rate that you are discounting by your YTM, and second is your redemption value. But for duration we have to calculate weighted average. So therefore, what do we do? Your year 1 to 6 we will write, every year you will keep getting interest. You will keep getting coupon. That is how much? 16% of 1000. 16% will be 160 rupees. So every year you keep getting 160 rupees, and last year you will get your 1000 original, that is your redemption value, plus you will get your 160 rupees. Your discounting factor for 17% is this for all the 6 years. You multiply it. So you get present value at 17% is these values. Perfect. Now you multiply this with your year. That is what we mean by weighted average. So you do 136.80 only has a weightage of 1, so you multiply it by 1. Your 116.96 has a weightage of 2, so you multiply it by 2. Therefore, similarly, this we multiplied by 1, 2, 3, 4, 5, 6. This is what we multiplied. Now we will sum it. That is, your sum comes to 4091.20. Now what do? We divide this 4091.20 with this number, that is 964.40. So you get that your weighted average duration is 4.242 years. Sir, what does this mean? This means that if you invest your coupon rate also that you are receiving at the same YTM, you will get back your entire money in only 4.24 years. You don't even have to wait the entire, or your weighted average is only 4.242 years. The lower the better. That means earlier you get the entire money. Okay. Second is the volatility. What do they mean by volatility? Volatility, they mean Macaulay duration divided by 1 plus yield. For Macaulay duration is 4.242 divided by your 1.17. This gives you 3.6258 is your volatility. Clear? Perfect. Next, let's move on to duration and your convexity. Okay, so over here, duration is your different. They use the same words, but over here it is different. So what do they mean? They are saying duration and convexity. This duration is not the same. Your institute uses the same words. So what are they saying? That duration is sensitivity of a bond's price to change in interest rates. We know that bond prices will change based on interest rates. As my interest rates go higher, my bond prices fall. As my interest rates go down, my bond prices increases. So duration talks about sensitivity of bond price to change in interest rate. The duration that they say it is linear in nature. What do we mean by linear in nature? We'll give you an example. So if the price today is 1000 rupees, if the modified duration is 3.5 years, not modified, this is the duration that we calculated above. Change in yield is 1% and convexity is 105. Convexity, okay, right now you can ignore. So it says change in price will be my price today into my MD, that is 3.5 years, into my yield change. So 1000 into my duration is 3.5, and how much has my interest rate changed? It has changed by 1%. So my interest rate is 0.01. So basically it says that bond price will change by 35 rupees. What they are saying, that means for every increase or decrease in 1% yield, the bond price will decrease or increase by 35 rupees. This it has given a linear number. For every 1% there will be a change of 35, but this convexity says no, this is not correct. Convexity measures curvature of bonds price. Convexity measures curvature of bonds price yield relationship. It tells us how duration changes when yield changes. Okay, so basically, if you see duration, okay, so if this is a graph and if this is your price and this is your yield, as per duration, it says my price keeps falling in a same pattern as my yield keeps increasing. It goes at a constant, but as per convexity, it says that if this is price, if this is yield, my relationship is not a straight line, my relationship is a curved line. It is a curved line, there is some convexity to it, therefore this is called convexity. So therefore my price will change as my yield increases, but not by a constant amount or not by a constant percentage. So convexity has this formula, that is change in price is equal to minus MD into change in Y plus half. This C star is your convexity into change in Y whole square. I know this is a little complicated formula, but let's learn it. Okay. So what was your MD? MD is minus 3.5. Okay. Into change in Y. How much is my change in percentage? That is 1%. So you multiply it by 0.01. Then you add 1 by 2. You plus 1 by 2 into your C star convexity. They have given you 105. 105 into y square. You get that my change is of 2.98%. When the price, when at the current price level, my change is only 2.98% and it is not 3.5%. Over here, when we calculated 35, this is nothing but 3.5 percentage. So as per convexity, it is not 3.5, it is 2.98%. They've also given you the method how to calculate C star. So in this case, your C star, that is your convexity 105, was already given to you. But if that is not given to you, you can calculate it in this way. How do you calculate it? That is V plus, that is price of bond if yield increases by Y, then V minus if price of bond reduces by so much, and your V0, that is your initial price of the bond. All of this will be given to you in the question. You just have to put it in this formula to calculate your C star. Perfect. Great. Ooh. And yes, I think this is our last part. Perfect. Next is your convertible debentures. What are convertible debentures? Convertible debentures are those debentures which can be converted to shares. So, an example, if your face value of a bond is 1000 rupees and if your issue price is 1350, your rate, that is your coupon rate, is 10.5%, your market price of the bond is 1475, and your market price of the share that it is being converted to is 80 rupees, and the conversion rate is 14 shares per bond. Oh, so much information. Okay, what they've given you? They've given you face value. They've given you face value is equal to 1000. They've given you issue price, that is at what it is issued at, is 1350. They've given you the current market price as 1475, and they've given you conversion rate. Okay, so basically if we were to convert this, how much is this? 14 into 80. How much is 14 into 80? That gives me 1120. Okay, so it is 1120. What is the premium over conversion value is the question. What is the premium over the conversion value? Got it. So your 1475 is what you would get in the market currently. And what is 80 into 14? That is your 1120. Tell me, is that correct or not? So basically, if you were to go into the market and sell it, it is 1475. But if you convert it to shares, it is only 1120. You divided this by 1120, so 31.7%. That means the market price of the bond is at a premium over the conversion value by how much? It is a premium over the conversion value by 31.7%. Okay, let's check the calculation. How much do we have? 1475 divided by 1120, which is equal to 355 divided by 1120 into 200, which gives you 31.69%. So your market price is at a 31.7% premium over the conversion value of the bond. Conversion value is basically how much of the share equivalent you are getting. Perfect. Next is your valuation of warrants. What do we mean by warrants? It is the right that entitles the holder to subscribe equity shares during a period at a stated price. That means we tell them that boss, you are able to buy this at a particular period only at a stated price. Okay, it is similar to convertible debentures, but option of conversion is detachable and hence warrants can be traded separately. So similar to a right, my warrant can also be sold separately. So what is the formula? It is the current market price of share. Current market price of share minus exercise price of warrant. Of course, this is your current price and your exercise price would be at a discount. If my current price is going 100 rupees, maybe my warrant would be for 80 rupees. So I have a profit of 20 rupees here multiplied by number of shares convertible per warrant. So this would be giving you your value of your warrant. Next is your zero coupon bond. Zero coupon bond is nothing. It is no coupon or no interest is paid during the life of the bond. It is issued at a discounted price to the face value and there is a lump sum payment in the end. That means they say that boss, my issue price is 60 rupees and I will redeem this at 100 rupees after 3 years. So therefore this 40 rupees gap is basically your interest payment over these 3 years, 4 years, whatever, but you will receive it only at the end. So there is no coupon payment during the years. Just I will take 60 rupees from you and at the end I will give you 100 rupees. The beats the 40 rupees in the middle is your interest payment. And coming to your last part, that is refunding of bonds. I would suggest all of you to use this approach rather than your institute approach because this is a much better method than the institute method. Okay, what do we mean by refunding of bonds? Refunding of bonds mean that whenever you issue the bonds, you issue the bonds say for maybe for 10 years and you issued it at 12% because that time the current market rate that was going on was 12%. Now after 2-3 years, your market interest rate had fallen down to 8%. But your bond will still be at 12%. So in such a case, you think that why not I give this money back to these bond holders and I issue a new bond at the new interest rate that is at lower 8%. So therefore, I will be saving 4% interest annually. Why am I paying 12%, which is a higher, which was the interest rate at that time? Correct. So therefore, this is called refunding of bond. You issue new bonds to pay back these old bond holders. So therefore, you are refunding it to them. So when bonds are refunded prior to its maturity date, especially when interest rates are falling, new bonds are issued at a lower coupon rate to finance refunding the higher coupon rate bonds. Companies will have to pay call premium because the company has called the bond earlier than the stated maturity, it will have to pay some call premium. Let's say an example, your original bond is for 300 million rupees. These bonds were at 12% and 6 years are remaining to maturity. Okay. They want to refund with new bond at the rate 10%. So say your old bonds are at 12% and your new bonds that you can raise are at 10%. Issue cost will be 6 million. Call premium is 4%. This call premium of 4% is from previous and this issue cost 6 million is from current. Unamortized cost of old bonds is 9 million. That means 9 million is still unamortized. That means this has not hit your PNL yet. Tax rate is 30%, discount rate is 7%. Calculate whether it is beneficial to refund the bonds or not is the question. Okay. So we will do this via different formula than the institute. We'll get the same answer, but a much better and much simpler approach. Okay. So first we will see that what will be my cash flows because of this refunding decision. So first I'll have to refund the old bonds. Refunding at old bonds will be how much? 300 million that I owe them plus 4% call premium. 4% of 300 is 12. So 312 will first be my outflow. Whatever is in red is my outflow. Next is your proceeds from new bonds. Proceeds from new bonds is 300 minus call premium. Sorry, what call premium? Your issue cost is 6 million. So therefore you will get only 294. And last is your tax saving on your call premium and unamortized cost. What will be your tax saving? This 12, this 12 rupees, what I say 12 rupees? Sorry, this 12 million plus your 9 million into your 0.3. That would be your tax saving, correct? So this 12 million that you paid over here, that is your call premium, plus this 9 million that was your unamortized. Everything related to the old bond will now hit PNL because your old bonds do not exist anymore. So therefore, this will immediately hit PNL. So this is your initial. That is at year zero, you will have an initial outlay of 11.7 million. We have to calculate whether the saving that we get every year when brought to present value will be more than 11.7 million or not. If no, it does not make sense to refund these bonds, but if yes, we should refund these bonds. Correct? So first we will assume our first case is if your original bonds is continued. If nothing is done, what will happen to our annual cash flow? So every year we will be paying interest of 12%, that is your 36 million. Then every year you will get tax saving on this interest at 30%. That is your 10.8 is cash uh, tax saving. Next is your tax saving on amortization. So you have how much? We have 9 million yet to be amortized over a period of 6 years. So every year we will be amortizing 1.5 million. We will get a tax benefit of 30%. So that is your 0.45. So your annual cash flow, if your original bond is continued, will be your 24.75 negative. If now we see that if new bonds are raised, then what will be my cash flow? My interest will now not be at 12%, it will be at 10%. So therefore 30 million. Then there will be some tax saving on interest, that is 30%. So that is 9. And next is tax saving on amortization. Of course, this amortization also you will be getting correct because this 6 million is your issue cost. So 6 million over 6 years multiplied by 0.3. So you get 0.3. So my cash outflow will only be 20.70 annually. Annually, it will be 20.70 versus if I continue with my new old bond, it will be 24.75. So basically, I am saving 4.05 every year. Every year for 6 years at the rate of 7%. If we find out the value, how much does it come to? 4.05 into 4.766. Basically, we are having benefit of 19.30. We are having a benefit of 19.30, and this is your initial cash outflow of 11.7. So therefore, you are getting a net benefit of 7.6 million rupees. Since your NPV is positive, bonds should be refunded. Is this clear? Perfect. This is a better approach than the institute module. I would suggest everybody follow this. And with this, we are done with this chapter, and I'll see you in the next one.